All right, welcome back, guys. In this video, we're going to start into mortgages, and we're going to talk some of the basics first and the components of a mortgage, and then we are going to start moving into strategy around how do we structure a mortgage, how much is enough, what kind of term do we do, 15-year, 30-year. We'll dive into all those details and how you make those decisions in coming videos. So first of all, mortgages, they are essentially just loans from the bank for the purpose of buying a home. Okay, that's all a mortgage is. It's a home loan. And they've had a lot of iterations. So since this product was created to allow people to buy homes, right, part of the American dream, they've had a lot of iterations, but they've been the way they are now. They've been that way for a while, and because they work out the best or the easiest for consumers. So there are a couple different types. There are variable rate loans and fixed rate loans. With a variable rate, you agree to a certain interest rate, but at certain intervals, like every year or every 6 months, that can adjust based on the federal interest rate that we talked about earlier. So if they raise rates, then your mortgage interest rate could go up. If they lower rates, your mortgage interest rate could go down. Okay, that's a variable interest rate. Usually, these are not super common right now because we've been basically at a floor in interest rates for the better part of a decade. And so interest rates are probably not going to continue to go down. So if you get a variable rate mortgage, odds are that you're just going to pay more interest over time as interest rates are increased by the Fed. So we're going to focus mainly on fixed rate mortgages and just take a look at the components. So I'm just going to explain through these briefly. We'll look at a sample mortgage statement, and then in future videos, we'll look at an amortization table and actual rates for mortgages right now and see what's out there, see what costs are involved, and actually break it down. So first of all, they lend you a certain amount of money. Whatever that amount is, you can break it down over any term. 15, 30 years is the most common. You can do 20 or other terms as well. But let's say you break it down over a 30-year mortgage, which is the most common. That payment is the same payment over every month for that 30 years. And the way they do that is at the beginning of the payment, more of it is going towards interest, less of it is going towards principal. And as time goes on, and as your balance goes down, then the amount of that payment that's interest decreases and your principal amount goes up. Okay, so we'll look at that when we see an amortization table, but that is the principal and interest, and that is the actual debt that's serviced. That's what we're looking at when we see, do you get approved for this mortgage, okay? On top of that, another component of your mortgage payment is property tax and interest. You might see escrow. Escrow is just a separate holding account that is for the purpose of paying property tax and insurance premiums. Those are usually annual costs, not monthly, typically. And so if you set it up this way, part of your monthly mortgage payment would be principal, interest, and your property tax and insurance amounts divided by, over the 12 months of the year. So the annual amounts divided by 12. And they just pull those out every month and set that money aside in the escrow account, and then they pay it when that's due. So they pay the insurance company directly, and they pay property tax directly, so you don't have to. You don't have to have it set up that way. You can pay those annually out of your own account if you want. For ease, it's usually set up this way, okay? That's called PITI or PITI, which is principal, interest, tax, and insurance. That's the kind of all-in cost. And then the only other cost that you could see on a regular basis is PMI, or private mortgage insurance. So generally speaking, for a mortgage, if you put down, the bank wants to see you put down 20% of the purchase price as a down payment. Now, if you put down 20%, you will not have private mortgage insurance, okay? You'll just have your PITI payment, PITI, property tax, the principal, interest, property tax, and insurance, okay? But there are a lot of programs out there and even conventional loans that will offer you the ability to put down less out of pocket as a down payment and just increase your mortgage amount. So there are a number of different programs for FHA loans or VA loans, or even loans meant for rural areas where you can put down as little as zero and just finance the entire cost. But in a conventional loan, typically the lowest you can go is around 3% or 5%. So if you end up doing whatever amount that is, if you end up doing less than 20% as a down payment, then the bank needs some extra security that you're going to actually pay off the loan. It's more of a risk to them. You don't have as much skin in the game. You could just walk away. And so what they do is they charge this private mortgage insurance essentially as an extra cost to cover their costs in case you walk away or default on the mortgage and they have to incur a lot of extra costs. Okay, so that's the other component. So let's just jump over to a quick sample mortgage statement. You see, very typically, this is how it's set up. See the account number, payment due date, the amount due. If you come down here, you'd see outstanding principal. So this is what you have left to pay on the loan. The maturity date is the end of the term of the loan. So in this case, it's September 2039. And then the interest rate, 4.75. Now this says until October 2012, which means this is likely a variable interest rate that changes in October, up or down, depending on the Fed rate. And in this case, there is a prepayment penalty. It's not very common, but depending on the terms of your loan, you could have that, okay? Now, if you look here at the current payment, they'll break it down for what the values are going to. So your regular monthly payment here is $1,669. Now they had a fee charged. It looks like a late fee because they missed a payment or they paid late. So then their total payment this month is that. But their regular monthly payment is $1,669. $386 is principal, goes towards the principal of the home and builds your equity. $1,048 is going towards the interest cost. And then $235 per month is going to the escrow account to pay for the annual property tax and homeowners insurance premium. Okay, so that's the very typical mortgage statement. And then down here, you'll see broken down by month and then year to date. So you'll also get a mortgage from your mortgage lender. They'll send you a tax document, which has your amount of mortgage interest paid over the year. So up to date, we're at $3,153. This amount is deductible against your income if you itemize deductions on your taxes. So we'll talk more about that later, but it's good to keep track of how much you're paying out of that and how much is going into escrow. Okay, so that's a typical mortgage statement. Those are the main components. There's no PMI here, which means they put down at least 20% or they have now at least 20% of equity. So that PMI has fallen off. It's not an additional cost, but you would see that listed in here if that were a present cost. So we'll go ahead and wrap up this video here, and then we'll jump into some actual rates and amortization tables in the next video. All right, see you then.
If you want to understand mortgages like a pro, stick around.